In this recording, we're going to wrap up the last two on the Chapter 5 worksheet. Let's look at number 5. Computing and analyzing gross margin. We're going to compute net sales, gross profit, and the gross margin ratio for each of these, A and B. Let's take a look. You've got sales, discounts, sales charges, allowances, and cost of goods sold. So let's do it. First, we're going to figure out what our net sales are. So I'm going to start with sales of $130,000. Less discounts of $4,200. Less returns and allowances of $17,000. Gives me net sales of $108,800. Cost of goods sold were $76,600. So my gross margin was exactly $32,200. I don't know what that's there for. Oops, is it going to let me take it out? I'm not going to mess with it. So what's our gross margin ratio? It's going to be 32.2 divided by sales. 32.2 divided by 130,000 or 29.6%. That's for A. Let's look at B. Sales were $512,000. Sales discounts were $16,500, so we're going to subtract them out. We're also going to subtract out your sales returns and allowances. So our net sales will be $490,500. Our cost of goods sold was $326,700. So our gross margin must be $163,800. Subtracting, taking our $512 sales less our $326 cost of goods sold, give us gross margin of $163, and our gross margin ratio is the $163 divided by the $512, or 33.4%. Now, I would say if these two companies are in the same industry, Company B is probably doing a little better. Either their prices are a little higher or their cost of goods sold is a little better because their gross margin is 4 points higher, and that's a big deal on $500,000. Okay, let's then move on and do the last one. We're going to account for shrinkage and do some closing entries. Remember what shrinkage is. It's stuff that's disappeared and we don't know what happened to it. So it's got to be cost of goods sold. So on July 31st, the inventory discloses the cost of the merchandise inventory still available is $32,800. Right? But the book says, look right here, the merchandise inventory is $34,800. A $2,000 difference. So what are we going to do? That $2,000 becomes additional cost of goods sold. And what are we going to do? We're going to reduce this inventory by $2,000. So merchandise, I don't think I have enough room, NDSE inventory. Going to be reduced by $2,000. Okay. So the next thing we're going to do is close the books. Close the books. So let's do it. Let's close the books. Let's close the books here. First, what do we know? We know sales were $157,200. We're going to close sales with $157,200. So we're going to debit sales for $34,800. I'm sorry, wrong thing. From 157,200. And we're going to debit what? No, we're not. We're not going to do this at all. We're going to debit sales for 157,200, and we're going to debit credit rather income summary for 157,200. We're not going to do sales at all. Right? Okay. How about the other accounts? Let's roll. What are our expenses? Sales discounts, 1,700. Returns and allowances, 3,500. I'm just going to abbreviate that R and A, if you don't mind. What's next? Now, how about this? How about cost of goods sold? 102,000 here, but oops, got another 2 here. So it's going to be 104,000, 102 plus 2 in cost of goods sold. What's next? Depreciation. Let's close that. 7,300. Salaries expense. 29,500. And lastly, miscellaneous for 2,000. Okay, add them all up. We're going to get $148,000. And that's going to go to income summary again. And that's all we're asked to do.